Think Realty Nation, it's your host Abhi Golhar. Welcome to the first ever episode of the Think Realty podcast. I'm super excited to be hosting the Think Realty podcast because one, we get to do video. It's on audio. You can download this at your leisure. And for the last couple of years, I've been the host of Think Realty Radio. And I still am the host of Think Realty Radio. We started that January 1st of 2018, and it's been an incredible journey and an incredible experience interviewing some of the industry's best when it comes to real estate investing and offering some of these insights and strategies, etc. And then we thought, let's grab the team together and see if we can make this a more interactive, so much more fun potentially. And guess what we've come up with? It's the Think Realty podcast. And I'm really excited to be hosting the Think Realty podcast because of all the amazing guests that we have lined up for y'all. And more importantly, that I have the final opportunity to prove that I am not just good on radio. I look great behind a microphone, don't get me wrong, but I think I look even better behind a TV screen. Only you can be the judge of that, so if you want to get in touch and let me know what you think, go to thinkrealty.com. I'm super excited today to have a great show lined up for you. We have a couple different segments. The first is going to be a little rundown on Baltimore, Maryland, and what I think of the market there, and of course some of the statistics coming out of Baltimore that you, as a real estate investor, should be aware of. Also, I have an incredible guest for you today. His name is Michael Blanc, and he knows multifamily investing through and through. He has downloadable Excel spreadsheets. He also has a best-selling book called Financial Freedom with Real Estate Investing, has a podcast, and invests in multifamily real estate himself. So excited to have him on the show. We're also going to be highlighting the 5 best counties for single-family rental investment. So all of that is coming up on the show today, and how millennials are changing home ownership. I'll offer some advice and some tips and some housing statistics on what you need to know with that. Because let's face it, I'm a super senior millennial, and I get it. We do, make a lot of change, and we're definitely changing a couple things here and there. Let's talk about what you need to know. All right, on to the show. Now, this podcast is brought to you by Renters Warehouse, one of the largest, fastest growing, highest reviewed property management companies in America. I'm super excited to be hosting this podcast. We're going to have a lot of amazing guests on the show to give you the latest information you need to succeed with real estate investing. Let's get started with Baltimore, Maryland. Now, if you are interested in investing in one city, I want you to check out Baltimore. Here's why. For 2018 year-end data, Adam Data Solutions reported a median home sales price increase 4.4% from the year before to $261,000. That's up 13.5% over the previous 5-year period, but still 6% below its 2007 peak. What's interesting about Baltimore is the following, okay? Here's what you really want to pay attention to. You really want this information. First, flipping activity accounted for roughly 6% of all home sales. What? 6% of all home sales? Like, are you kidding me? That's awesome. That means there's plenty of opportunity for investors to make money here. Also, while the number of flipped and distressed properties were lower statewide in 2018, Maryland still experienced the 3rd highest foreclosure rate. So you know what that tells me? You know what that, if there's any, you got wedding bells, right? You got, Christmas bells. This is like music to my ears. This is amazing opportunity here, folks. You need to be taking a look at Baltimore and the overall Maryland area. Now, here is the most important part that you need to be paying attention to. You ready? I'm going to read it word for word for you guys. Flippers in the city, okay, if you're a flipper in Baltimore, flippers in the city made a gross return of 142.3%, while flippers in the county saw an 87.9% gross return on investment. What? So we have a city, we've got a state where you have an incredible amount of return potential to not only contribute to making the city better and look better and really help the citizens out, but on top of that, you're able to make a significant profit margin? All you California investors and New York investors, you'll have to check out Baltimore. I mean, heck, I live in Atlanta and I'm moving to Baltimore. All right, here's what's coming up next. My really good friend Michael Blanc from themichaelblanc.com. He's a multifamily investor. You cannot miss this information. We're talking about trends. We're talking about a little residential real estate investing and why you should consider multifamily as your go-to investment option and opportunity. See you in a second. Hey everybody, it's Abhi Golhar again. Welcome back. So I'm excited today to interview one of my really good friends. He is an apartment complex investor. He's a real estate investor. He knows what it takes to win in the world of apartment complex investing. And this is somebody that needs no introduction. He is an individual that I've been following online for quite a while, and so should you. His name is Michael Blanc. Michael, welcome to the show.
It's great to be here, Abhi. Thanks so much.
Hey, you got it. So there's a lot of stuff happening in the apartment complex world today, and quite frankly, you are on the cutting edge and cusp of that information. Let's talk about rentals real quick. Why do you feel there are going to be so many renters? What's the trend line for renters looking like in 2019? Is that looking like here? Is that looking like here? What are we kind of thinking?
Yeah, it's very strong for 2019 and beyond. And I think one of the drivers is that the younger generation it doesn't really have the money for the down payment, and that's driving them to renters. Also, last year interest rates went up about 1%. And what that did is it increased the cost of monthly house mortgage payment by about $175. And there's a gap between the average mortgage payment of $1,700 and the average rent. So because of that gap, more, especially young people and just the population in general, is driven to rentals. Also, the millennials saw what happened in 2008 with the crash and what their parents went through. And all of that demand drivers are really driving people into rentals. The most affordable ones, Class C or Class B minus, is that projected the lowest vacancy rate in like the last 15 years, like 3.9% vacancy. So demand for, especially the more affordable rental stock, is extremely strong.
So there are a lot of reports here that I've been looking at that are suggesting, one from RealPage I'm looking at now, that says that apartment resident retention is hitting an all-time high in 2018. Do we expect that to continue into 2019, maybe 2020? And that's question number one. But also to follow up on what you're saying, I'm seeing the same trend line here. Right? There are many builders out there that are not really building. It's not financially economical for them to build within the $200,000, $300,000, $400,000, $500,000 price point because, quite frankly, cost of materials are high, cost of labor is high, the timeline to get permits is even higher sometimes, depending on what city that you're in. So all of that gets wrapped into the cost that the millennial or that the renter is going to have to now buy and turn into this homeowner. And I'm not really seeing that to be the case. So going back to this RealPage report, what are you finding there? Do you agree with the fact that the retention rate for apartment complex residents is at an all-time high 2018?
Yeah, I think that's an accurate prediction for 2019 and beyond because the rental demand is so strong. We don't see that gap closing anytime soon. They're not building any more affordable rental stock, so Class B, Class C, and that's because for the reasons you said, it'll cost upward of $120,000 a unit to build something, but we're buying stuff at $40,000, $50,000, $60,000, right? So no one's gonna build that. So what's happening is we have a high demand for affordable rental stock, and there is literally a limited supply. So I think that is absolutely right. That trend is going to continue in 2019 beyond, and I think even for the longer term as well, regardless of what happens with the market.
So I do want to ask you at some point in time where you're finding your deals, and maybe you can reveal some of that secret sauce for us because I'm curious and I want to jump into these areas. Totally kidding. But let's rewind a little bit. Help me understand a little more about who Michael Blanc is. I mean, I know you've written the book, Financial Freedom with Real Estate. You have an awesome podcast as well. Not only are you very well liked in the industry, but you have a massive following. You have a good understanding of the market, and you talk about it every single day. So take us back to the beginning. Help me understand who is the real Michael.
Yeah. Okay. Well, I don't know how much time we have for that, but I'll give you kind of the cliff notes. I'm like a lot of other people. I was taught to go to school, get good grades, get a job, and that's what I did. I happened to get into computer science and programming, spent some time in America Online, and then I started I joined a startup company very early on. It was the right place, right time. Went public in 2000, put a bunch of money in my pocket, and then Abhi, I read Rich Dad Poor Dad. and it completely ruined my life.
I know, it ruined my life too. Rich dad, poor dad. Man, I'll tell you that story in a second.
Terrible, right? So,
No.
so I decided to abandon my entire background and pursue financial freedom. And because I had money, I just quit my job and did everything at once. I learned, I learned how to flip some houses, learned to trade stocks and options, took an apartment boot camp. But my big idea was restaurants. And this is because I was surrounded by franchisees, and they explained to me how the business works. It costs this much to open. They would hire someone to run the whole thing, and they would essentially sit back and count the passive income. I was like, that's it. So I went all in. Now, long story short, I subsequently lost my IPO millions in the restaurant experiment and clawed my way out with real estate. But like so many people, it was with single family houses. In my case, it was flipping houses. I had to learn how to raise money because I didn't have any of it. I got into an apartment building, and after a while, I was making great money on the house flips, but it was so much work. And meanwhile, this apartment building is sending me mailbox money. I was like, shoot, I got to stop doing that and do more of this. And that's what I started doing. And people started asking me, how are you doing this? How are you raising money? How are you structuring these deals? So I started blogging about it. And then I created a syndicated deal analyzer analysis spreadsheet. I created online tools. I created a podcast that you mentioned. And I began to see a pattern, which was the people who had done their first multifamily deal, literally within 1 or 2 years, quit their job. Like, it was so pervasive, so universal, that I called it the law of the first deal. And that's why I wrote my book around this. It's called The Financial Freedom with Real Estate Investing, because while most people may get started with single family house investing, they quietly do it with apartment buildings. And they do it without prior experience in their own cash. And that's very exciting to me. So really my mission right now is to help people quit their jobs with real estate, but it may not be in the way that they think, which is single family houses.
So part of that story, I love the story, and thank you very much for sharing that, because there are a lot of folks that are listening, that are watching as well, and they're like, well, I fall into that bucket, right? I fall into the 9 to 5, I make $100,000 a year, or I'm a business owner and I'm doing really well. How do I get involved in something like this, and does this require a lot of my full-time attention? Can you talk to that just for a quick second? How time-intensive is investing in multifamily? Let's say I want to be a passive investor.
Yeah, I mean, first of all, if you're happy in your 9 to 5, there ain't no problem to be solved here. So let me just say that, right? But if for some reason you don't see yourself doing this activity for the next 5 or 10 years, and you're looking for a solution, you're thinking real estate, this might be a great way to do it. Like most people who are passive income, who have some kind of money to invest, they tend towards the stock market. And there's a variety of problems with the stock market. It's very volatile. The tax is very high. It's kind of an uncertain future.
That's right.
And the question is, well, what else is there? And the answer is, the best thing that I know for passive investors is multifamily syndication real estate. And the good news is, I mean, anytime you invest in anything, you should educate yourself. So having said that, I don't think the average person really knows anything about the stock market, yet they put hundreds of thousands of dollars into it.
That's
so
right. Or you'll buy the Lyft IPO, right? 3 Fridays ago, the Lyft IPO started, it was like $78 a share, and now it's down to like 56. I think it just closed at 56 and a quarter. So it's like mind-boggling to me why people will do that. I don't get it. I'm sure you've analyzed this phenomenon. I think it's called stupid. I mean, I try to analyze it. I don't really kind of know where people's heads are. But like you said, they'll just throw money away in a stock. I just don't get it. Why is that?
Well, I don't know. I think investing in multifamily is not nearly as exciting as an IPO in general, especially something like Lyft. But what you don't hear about is the crash and burn and total loss of capital.
That's right.
But what I love about multifamily is it's much more boring, right? It's much more boring. But what I love about it is much less volatile, much more consistent. Okay, that's number one. Number two, you get cash flow from your investment, which you don't get from stocks unless you're selling puts and calls. You get cash flow every quarter. Wow, that's pretty cool. And then the returns you're getting from investing in multifamily are actually way higher than the stock. And then coupled with that, the tax benefits you get for investing in syndications and real estate in general are extraordinary. Like the government wants you to invest in real estate. In fact, you're going to spend hardly any money on paying taxes at all. And that combination, by the way, exists nowhere else in the world.
If you're listening to this and you're like, I need to get in, that's the reason, if any other reason, you should look at investing in multifamily. And then make sure that you go to themichaelblank.com, www.themichaelblank, B-L-A-N-K, except it's not blank, it's blanc.com. So definitely check it out. Michael, when I'm looking at increasing revenue for my apartment complex, there are multiple ways to do that, one of which is raising rents. Is that a deterrent for potential renters, for potential clients to come in and say, well, geez, it's at $500 a month or it's $700 a month and now you upped it to $750. Should I be concerned about that as an investor, potentially driving away potential renters to my apartment complex?
Well, it depends, right? It depends on what's the rent in the apartment complex next door, right? Because the tenants know this, right? And if the rents are low, you're going to have your occupancy is going to be very high, and they're going to stay there. So if you raise by $50 and now it's the same as the one before, you've just raised the income, and your occupancy might go from 100% down to 94%, but your revenue goes up much, much higher. The good news about multifamily is that you don't have to do much to increase the value of the building and the return for the investors. Not much. $50 in rent can easily result in $1 million or more in profit for an apartment building. So you don't have to be some magician and hit a home run to actually increase the value of an apartment building. Just little tiny tweaks will do it.
So let me ask you the question that I know a lot of folks are asking or thinking about right now. Why multifamily, and why not just stick to single family, residential, right? Give me a 3-bed, 2-bath, 1,500 square feet in the middle of Alabama, and I can buy 500 of these and just call it, right? Like, why not do that? I mean, don't get me wrong, I understand where we are in the residential market right now. Prices are cooling a little bit, longer days on market, this and that and the other. But listen, I mean, Michael, if I'm investing for the long term, what gives?
Yeah, I mean, a lot of people know single family houses. So as a passive investor, someone who's, man, I need to get myself out of the stock market and real estate, they're thinking two things. One is, hey, let me buy a rental property. And they do that. And this is great. It's okay, I'm going to buy one rental property a year. Yep. And that's pretty great. And once they get to around 5, they're like, my gosh, this is a freaking nightmare. And by the way, to replace my $10,000 in expenses, I need to buy 15 more. And I'm not doing that. So then they go, okay, well, I'll go with turnkey providers. And that's great, because turnkey providers are much more passive. You own the property, but someone essentially does everything. And that's not bad. The problem is, what if they don't perform? And this, I've known lots of stories where they buy some turnkey in Memphis and it doesn't go well. It's vacant for 1 month, 2 months, 3 months. And now what is the passive investor going to do? What are they going to manage it remotely? Are they going to try to find someone to manage a single house or second house? So now they have a nightmare on their hand. And after you've solved all that, you're still subject to the single family residential market, which can go up. And as we saw in 2000, now it can go down a lot. Yeah. Versus that volatility doesn't exist in multifamily. And number two, it's much easier to manage. You can outsource it.
So I appreciate the information on that. I mean, I like both asset classes, don't get me wrong. There are pros and cons to both, but I do understand your position on multifamily and the fact that there are some better riches to be made there. And quite frankly, it's a business, right? You acquire an apartment complex, you're acquiring a business. You have property management, you have everything that goes with it. So make sure, again, visit www.themichaelblank.com and get all the information that you want. His recent book, Financial Freedom with Real Estate Investing, pick that up. You can do so at Amazon. Michael, 2 quick fire questions for you. Ready? We've got 1 minute. Like, I've got Ron looking at me. He's like, you got 1 minute. Okay, 1 minute. Number one, what markets do you like right now for multifamily acquisition?
Yeah, Sunbelt and Texas. So everything that's warm is sunnier.
Warm and sunny. I like that. I mean, I can always look. I'm cool with a good tan. It's not a big deal. Miami's calling my name, believe me. Number two, what's a good pathway for new investors to get started with multifamily? Those that are your high net worth individuals, they have great jobs, 6 figures. I mean, they're doing really well. Business owners, entrepreneurs, they've made it in the business game, but now they want to take that money and move it to multifamily. What's the pathway?
Yeah, the best way is to meet and network with operators and syndicators like me. So you can go to my website, click the invest button. You can register yourself in our investment portal, and then we'll have a conversation. But there's other people like me as well. So you have conversations. Who do you resonate with? And then start investing with them and see how they perform, see how they act, and that's how you get into the game.
Awesome. Michael, thanks so much. That's all the time we have for today. Certainly appreciate you jumping on the show with me. That's awesome of you. What's the best way that our listeners can get in touch?
You said it already. It's themichaelblank.com. It's BLANK at the end, or just Google apartment building investing, and you will find me.
Michael Blank is an awesome guest. He's a great friend of mine. What awesome insight about multifamily, and of course, a little bit of that comparison toward the end with single family and multifamily real estate investing. Listen, at the end of the day, you're an investor. You want to know what works best for you? Try a couple things. It doesn't hurt. Just make sure that you do your due diligence and you pay attention to some of these trends and you follow the right influencer. Michael Blanc is one of those influencers. Check him out. Go to www.themichaelblanc.com. All right. This next segment is brought to you by Narada Real Estate Investments, your premier source of cash flow investment property. Visit www.turnkeyrealestateinvestments.com. Let's talk about the 3 best counties for single-family investment. Now, interestingly enough, Georgia's on this list. There's a county in Georgia that is on this list. But these aren't the only 3 counties that you should consider investing in. There are other counties across the United States where you can make a lot of money. But you want the 3 best? Let's do it. Number 3. Let's start with number 3. Number 3 on the list is Cumberland, New Jersey. Cumberland County, New Jersey. You're looking at annual gross rental yields between 20-22%, sitting right at about 21.2%. Keep in mind, you make your money when you fill in the blank. That's right, when you buy. So some of the time, your yield will be a little higher. Sometimes your yield will be just a little lower, but roughly this is what you should expect. But again, this is so based on price. If you're not buying at the right price point, you're not going to hit some of these yields. So I'll give you my little formula here in just a second. Coming in at number 2, Bibb County, Georgia. Oh, sweet home Georgia. That should actually be the song. We should change it from Sweet Home Alabama to Georgia. I'm for that. If you are for that as well, go to thinkrealty.com and, cast your vote. Or we'll go figure out a way to make that happen. So your annual gross yields, rental yields in Bibb County in the Macon metro area, roughly about 21.9%. Coming in at number 1. Do you want to take a quick wild guess of what this is going to be? What city this is going to be? Well, we just finished talking about it. It's Baltimore. Baltimore City, Maryland. 24.5% annual gross yields. Here's the formula though. When I'm looking at single family rentals, I want to make sure that I can hit those yields, that I can hit those returns. And that comes with buying right. So most of the time, I'm looking at a 3-bed, 1-bath or a 3-bedroom, 2-bathroom home, roughly about 1,000 square feet to 1,400 square feet. It has a paved driveway. And I'm also looking to follow the 1% rule. Now, that is reasonable. The 2% rule in local markets that are experiencing really high growth may not be as favorable. And quite frankly, it may not be achievable. What do I mean by these rules? I'll tell you. 1% rule means my all-in cost, let's say my all-in cost is $50,000 to buy a home and renovate it. I know, you're thinking, well, geez, that's not the case in LA. Well, we're not talking about LA, all right? We're talking about a more, well, what's a good word? Reasonably priced city anywhere, USA. So $50,000, that's my all-in, my acquisition, and my renovation. 1% of that is going to be my monthly rent, okay? That's what I'm kind of looking at. And of course, it also depends on the amount of leverage that I have in the property as well. If I'm leveraged to the hilt, then I'm not going to see as much cash flow, even though my gross yields may be in the 20s. So those are the top 3. Again, number 3, Cumberland, New Jersey. Number 2, Bibb County, Georgia. And then number 1, Baltimore City, Maryland. Way to go, Baltimore. I'm excited. The O's, the Orioles. And when I was there for Think Realty Baltimore, that was a really, really fun time. I didn't get to see the Orioles play, but I think they were playing the Yankees when I left, and I think the Yankees were one up on that series. So anyway, I'm a huge fan of the Orioles. Way to go, guys. And those are the 3 best counties. I wish I had the 5 best counties for you, because then I'd be able to continue talking, but we got to get to the next segment. So we've learned a lot so far. What have we learned? The formula, the secret sauce that you need to know when buying single-family rentals. That's number 1. Number 2, the 3 best counties for single-family rental investment. Check it out. Have any questions? Go to thinkrealty.com. We're going to flow right to the second segment, which is how millennials are changing the way that home ownership in America looks like. Now, I'm a millennial, except I consider myself like that super senior millennial. I kind of like the super senior that stayed behind in a high school to play like an extra 2 years of ball when I probably shouldn't have been there. That's like the weird version of millennial that I am. I still haven't figured out what that means yet, but if you can help me out, I'd love it. I mean, just let me know what I fall into, because I want to be accepted. All right, number 1, Millennials. Guess what's happening? They're renting longer and buying later. The Zillow CEO Spencer Raskoff said, quote, "The whole real estate industry now is characterized by extreme scarcity and inventory." Isn't that right? I mean, isn't that true? If you're a millennial and you're looking at buying homes right now, what are you finding? Like nothing on the market, especially in the price points that you want. Your starter homes between $150,000 and maybe $300,000. There's hardly anything out there, especially in some of these primary markets. And quite frankly, sometimes it's hard for builders to financially and economically build because the price of materials is so high, the price of labor is so high, and it just takes time to do these new construction developments or even just to renovate. I mean, do you know how long it takes sometimes to get permits? Do you see all the gray in my hair? That's from getting permits, okay? So you want to be careful of that if you're a home builder. But I'll tell you, that's number one. That's one of the reasons why millennials aren't buying right now. They're just renting a little longer and buying later. Number two, when they do buy homes, they're buying in the luxury market. Now, here's what's interesting. A millennial like me, let's say I'm renting, right? Let's say I've been renting for the last 5 or 6 or 7 years, and now I'm your mid-30s. I'm 34 right now. I know my birthday is in August, so happy early birthday to me. But let's say I'm turning 35, 36, 37. You know, I'm not going to be looking at like a $130,000, $140,000 home. I want something a little better. You know, I might be looking at a $400,000, $450,000 home. So Raskoff, who's Zillow CEO, says, quote, "When millennials buy their first home, they're buying a much nicer home than their prior generation." It's interesting, right? I never thought that I would really kind of understand that. And he added, quote, "Many people are basically skipping the starter homes." So if you're not looking at a starter home, you're just like, I don't even want that, right? I want something that is north of $350,000, $400,000, which, quote, he says, "They're renting until their 30s. Okay, I'm actually just reading this research now for the first time. I don't even have my orange highlighter out. They are skipping starter homes. They're renting until their 30s. And that first house they buy is like $1 million. He's saying, quote, "They're just not even buying the $200,000, $300,000, $400,000 homes, even though there's a lot of demand for the starter homes." And it's a total mind shift when compared to previous generations. All right, they're just buying later and then buying them bigger. I don't know. What do you feel about that? Weigh in. I mean, this is supposed to be interactive. Get in touch. Go to thinkrealty.com. You can find me anywhere online, right over here. You can find me on Instagram, LinkedIn, Twitter, Facebook, whatever. And, quote, "Part of it is generational. Millennials didn't feel the need to buy a starter home, and maybe they could have waited. And for less than $350,000, and that, I mean, if you're living in New York, that's not even going to buy like half a studio, but it buys a studio in Brownstone, Brooklyn these days, not Manhattan, you Manhattanites. And they're finding that they can afford these homes with 3 bedrooms or more on several acres of land. I mean, and from an investment perspective, you know what's happening? Here's what's happening. Millennials will even rent a little more and then go buy a vacation home or go buy an investment property somewhere in like Florida, Alabama, Chattanooga. I mean, we're looking at some of these cities and states, and they're building a portfolio, which is great. They see cash flow, and guess what? They're winning on the investment front. They're winning on the portfolio building front. And then they have the financials to buy that $500,000, $600,000, $700,000 home. I don't blame them. But listen, if your financial future is covered first, that's really what you want to pay attention to. You can buy whatever you want. Just don't go too excessive. I think the $1 million home just doesn't make a whole lot of sense unless, you know, you live in Los Angeles or Beverly Hills or New York City, where I'm not going to live. I'm very happy with Atlanta. I like Atlanta, and so my home's not going to be $1 million. All right, that being said, we've got to wrap up the show. Thanks so much for listening. Thanks so much for joining me on the inaugural episode and show for the Think Realty podcast. Super excited to be your host and to continue this journey of learning real estate investing with you as we progress with amazing guests lined up for you. We have Tom Olson that's coming on. We have Glenn Stromberg and so many amazing guests as well that you'll learn from and some strategies that you can implement right now in your business to see that yield, even though inventory is a little lower and it might be a little harder to get into the game. We'll teach you how to beat it and win. This entire podcast was brought to you by Renters Warehouse, the largest, fastest growing, and highest reviewed property management company in America. Think Realty Nation, that's a wrap. Thanks so much for joining me again. Get in touch with me anywhere online at Abhi Golhar. And until next time, happy investing.